Yeah, I think the weather really was a story for those February numbers, and there'll be more. We've got housing starts today, home sales, durable goods next week. They're all going to be trashed by the storm. But I think that effect is pretty clear. And my guess is that what Jay Powell will do today is gloss over those, point out that the outlook is improving dramatically. But at the same time, I think he will push back on some of the market's inflation fears. Again, he's done this a few times recently. And I think he'll want to make the point that, look, this is still a forecast recovery. So talking about policy response to a forecast recovery and a forecast future inflation risk is still very premature. I'm optimistic, but let's wait and see what happens. I think that will be the tone.
The last time we heard from Jay Powell, there were a lot of commentaries suggesting, well, he could have done more. This was a missed opportunity. He could have encouraged rates lower through stronger language. And yet, the other side of the coin was a suspicion that maybe he was doing what he was doing to let a little bit of gas out of valuations in equity markets and to cool some of this Reddit stock trading behavior. What's your interpretation? Because I know that there was a level of dissatisfaction around how Jay Powell talked about the spike in bond yields last time round.
Yeah, I think a lot of people in markets' expectations ran a bit ahead of themselves. I don't think he was ever going to come out and say, we've got to stop this rising yields. It's a terrible thing and we're going to take action about it. And first of all, the Fed doesn't work that way anyway. It's not a one-man band. Decisions are made fairly slowly and deliberately, except in times of total crisis, which this very definitely isn't. So I think as well, a lot of Fed speakers have talked about how the increase in yields has mostly been driven by a rise in real yields, which is a reflection of improving growth expectations, rather than a big surge in inflation expectations, which would be a different story from the Fed. We know they're obsessed with inflation expectations, but they really haven't moved all that much. So I think from Mr. Powell's perspective, this is still a development which is not really very scary. Of course, if you are along of 10-year notes at 1% and you're still sitting them at 1.6%, it's been very uncomfortable. But from a macro perspective, as your survey suggested, a 1.6 10-year note is not the end of the world. It's still close to zero in real terms. Plus, of course, they're still buying $120 billion a month, and fiscal policy is about to become astoundingly accommodative again. So does the Fed really need to step in and try and dampen bond yields at these levels? No, I don't think it does. I'd be astonished if they did that today. Even if they took any steps towards doing that today, I think they'll stick to the same line.